Hello, everyone. The webinar has started. I'd like to introduce Chad Webb, our managing partner.
Thank you, Tammy. Yeah, this is Chad Webb, managing partner of ADDICUS. I'd like to thank everyone for joining us again today. I know we've done a number of these. I think this is our fifth or sixth webinar that we've done talking about all of the COVID-19 related matters, and we've spent a lot of time talking about PPP, both the loan side of it and then the forgiveness side of it. Today we'll really be focused around the eligibility and forgiveness on PPP as well as EIDL loans. As you'll see in the material, it's very material heavy, which is a term that Cammie taught me earlier today. I didn't know about that, but I'm going to use it going forward. But do want to make sure that all of you know that we are going to send the materials out to all of the participants and a copy of the slides. We also have a white paper that this group of panelists has been working on related to these matters, and we will disseminate that accordingly as well. So again, thank you for being here today. Thank you for sticking with us during this process and giving us a chance to really help you with your business and financial matters. It's been a very intense time for all of us, and we have really appreciated the challenge and the opportunity to serve so many of you. With that being said, I'd like to introduce today's panelists. Many of them you have heard from before, and I will jump right into that. So Drew Adams. Drew is a founding partner of ADDICUS and serves as our chief enterprise architect. Many of you work with him, but he is our resident technical expert on all matters financial. Brandon Dixon is the chief counsel for ADDICUS. Brandon is a tax attorney and serves in many areas across our firm and certainly in the industry as it relates to financial, tax, and accounting matters, and certainly law matters as well. Patrick Everman and Lee Johnson are with Balch & Bingham. Balch & Bingham is a firm that we do a lot of business with, very popular in the Southeast. As many of you are aware of the firm, they have a full suite of services that cover legal services across the board. Patrick joined Balch & Bingham really about 5 years ago and has been really spending most of his time in the commercial space and real estate space. He does a lot of partnership with us and really serves us and our clients in a variety of different areas. You can see on the slide in front of you where his practice areas are, but I'd say he's really well-versed in commercial business transactions, commercial real estate, and partnership matters. Lee is another partner. While Patrick is in Jackson, Mississippi, Lee is in Houston. Lee is in Birmingham. Sorry about that, Lee. I know you want to go to Houston, and we've talked about it, but Lee's in Birmingham. And also, similar to Patrick, Lee specializes in real estate and dealing with commercial transactions, but one of their experts in terms of real estate transactions and certainly provides great counsel to us. So Lee is a partner for the firm and deals with that corporate area and real estate matters. With that, you will be hearing from them individually, and we'll have time for Q&A afterwards, and so I won't spoil too much of that. But the style of today's webinar will be similar to the ones you've heard in the past or participated in the past. However, we are not going to be as heavy on delivering messages related to each slide individually. We want to save a lot of time for Q&A. We've heard feedback from all of you that has been the most valuable, and so we want to respond by leaving enough time for Q&A today. Additionally, while we go through today's webinar, I will serve as an MC. Drew Adams will be also involved, adding comments and commentary throughout the entire presentation, but we want to make it more conversational. And so we'll ask questions and then also try to tee up some, again, for the Q&A session. If you have any questions that you've not submitted to any of us previously, please do that in the chat function as part of the webinar. We look forward to your questions. That's why we do these. So please don't be bashful. And for those of you that are out there that have my personal information, feel free to text or email me, and we'll make sure those get handled as well. With that being said, I'd like to go ahead and jump right into it, and I'll hand it over to Mr. Patrick Everman from Launch. Patrick?
Thanks, Chad, and glad to be here today and get to talk about these forgiveness rules that are coming out for the PPP loans. And I know they've been highly anticipated. And before we really get into them, we're gonna give you a little legislative update because just when we think we know the rules, the Treasury has thrown another curveball. And coming down the pipeline is what's called the PPP Flexibility Act. The House passed it last week, and the Senate is attempting to push it through as written, and we're still waiting to hear when that may come through. So I'm going to cover the high points of what this PPP Flexibility Act would do to the forgiveness rules. And as we move through the webinar, though, we'll when we discuss a rule or regulation that covers something that the Flexibility Act would change, we'll make sure to notate that. So the first big thing that the act would change is that it's going to expand that covered period from what we now know is 8 weeks to 24 weeks or December 31st, whichever comes sooner. So giving everybody a little more time to use those proceeds. It's also going to expand the safe harbor for full-time equivalent employee and salary or hourly wage reductions to the end of the year, 12/31/20. It's going to expand criteria for the safe harbor related to inability to hire or rehire or an inability to return to pre-COVID-19 levels of business. And so while there already are some safe harbor criteria related to those things, these are two new categories that are more narrowly tailored to businesses that are basically going to be affected much past the original 8-week or June 30th time window. Right now, there's a requirement that the borrowers must spend 75% of the loan proceeds on payroll and no more than 25% on non-payroll costs, and the act would actually relax that and allow up to 40% of non-payroll costs. In other words, only having to spend 60% on payroll. Also, there's an employer payroll tax deferral under the CARES Act that originally prohibited a borrower for a PPP loan from taking advantage of those deferments of payroll taxes. And so they're going to lift that prohibition, which will allow borrowers to take their up to the amount of Social Security tax or 6.2% of their payroll tax and defer that half to December 2021 and the other half to December 2022. So that'd be a big benefit to borrowers and really free up some capital for right now. They're also proposing to increase the minimum term of the PPP loan, which everyone that's taken a PPP loan was given a 2-year term, and it's going to increase that minimum up to 5 years. It would also extend the deferment period for principal, interest, and fees. Right now it's set at 6 months, but they're going to extend that out to the time upon which the SBA actually remits the forgiveness amount to the lender, which from the time of application of the PPP forgiveness, the bank has, I believe it's 30 days, and then the SBA has an additional 60. So it's going to end up pushing this way out past that original 6-month deferral and can be a big benefit for those that end up with an amount after the forgiveness. And so, the big question is, how is this Flexibility Act going to affect the calculations? And it's going to do it in a number of ways, and we'll be discussing that throughout this webinar.
Yeah, and so this is a very key slide, Patrick. Thank you for hitting that, and it really summarizes a lot of what we want to cover and some of the things that we'll get into in Q&A. But I do think the key things for the audience to take away are that the 8-week period, we've all heard, 8 weeks, when does the 8 weeks start? When does it end? Can I pick any 8 weeks during the period? That's changed to 24 weeks, right? And earlier between 24 weeks and end of the year. And then the other matters are really highlighted on there. But I'd ask everybody to make sure that they concentrate on this slide, because I do think, number one, like Patrick mentioned, the rest of the presentation will certainly be a derivative of this slide, as well as Q&A. And Drew, I'd ask if there's anything you want to highlight to the audience before we move into the rest of the meat.
I don't think anything earth-shattering other than to say that, the Senate was going to vote on this afternoon. One of the senators blocked it. I do think we all expect it on this call to pass, but it hasn't passed yet. And so all of this is somewhat TBD, but should it pass, and we believe it will have a significant bearing and give quite a bit of flexibility. But we're proceeding, at least at this moment, as though the rules we have are the rules we have, and those are, will be the rules we continue to calculate based on until we know something different.
Okay, with that, so let's go ahead and, Patrick, let's go ahead and go to the next slide and keep this thing rolling and see how quickly we can get to Q&A.
Sure, definitely. And one big thing that's, I guess, a little over 3 weeks ago, the Treasury came out, and one of the burning questions through all of this was the good faith certification, because originally, it was based upon the necessity of the loan, which was the basis of the good faith certification, was based on the current economic uncertainty in the country right now. And so after this came out and the SBA started to put out regulations, they caused a lot of concern, because they seemingly tried to shift the burden of necessity onto the capital or liquidity of the businesses, which just wasn't what the true intent of the statute originally said. So the Treasury comes out on May 13th, and what they say is any borrower that received a loan under $2 million is going to be deemed to have taken that loan in good faith, not presumed, but deemed to have taken that loan in good faith, or to made the certification in good faith. I'm sorry. And so, what we would say is, if you got a loan for under $2 million, you don't need to be overly concerned about whether, that certification. And for those that received a loan over $2 million, you don't automatically have to be concerned, because the Treasury has made it clear that you are going to have an ability at the time of forgiveness to make a basis for having made that certification in good faith. And just from a review of the application, it hasn't become entirely clear how or where, but they aren't requiring you to remake that certification that you made on the application. All they ask you to do is identify whether or not.
So Patrick, what you're saying here is that as we went through this and everybody did their application, a lot of it was you were filling out the application and trying to obtain the funds because there was uncertainty in your future as a business. They came back, Treasury did, and created a safe harbor for those that are under $2 million, right, to protect them. But for those above $2 million, they still need to maintain contemporaneous documentation to show that it was due to uncertainty, right, as a borrower.
Yes, absolutely.
And I think
anything around this. Go ahead.
I think uncertainty is very broad. I don't think there are very many business owners in this future, irrespective of the condition of their balance sheet or their current operations, who weren't concerned. In many cases, immensely concerned. I know we were when this all started to happen, and it wrecked us for a couple of weeks trying to figure out what's the new normal, where are we headed with this, how's this going to affect our business, are our clients going to continue to pay us and need our services? I think by and large, many businesses face that. And, I think you need to go back to that time period and to the extent you haven't already documented that, document the conversation you were having with your advisors, with your friends, with your colleagues, with your business partners. I think there's a pretty good case for many of these businesses, again, irrespective of the financial health. Many businesses are diverse in terms of their financial health, but that doesn't mean there wasn't tremendous uncertainty. I think the key is to document that. We have a couple of clients right now that we are concerned about it, and we are looking at that had well over $2 million in loans. And we're doing everything we can to make sure we button that up so that we feel good about that. One other very important point I want to make about this particular safe harbor, there have been a number of really quality advisors and very sophisticated clientele and friends of the firm that have read this to mean that there's a safe harbor on people who receive less than $2 million in funds and that their forgiveness will be automatic. And that is absolutely not true. That is bad advice. And this safe harbor has absolutely no effect on the forgiveness of your loan.
Yep, and that's a big piece. Patrick, if you will, go ahead and quickly hit the next slide and then kick it over to Lee to talk about covered periods, please.
Sure, yeah. So the PPP forgiveness application, we received that, and there was some analysis and commentary that has been received, has been helpful, but I mean, there's still a lot of questions out there on the PPP application. And the SBA and the Treasury are going to continue to field those questions and provide guidance with their their frequently asked questions and their interim final rules. And as they become aware of issues presented by both the borrowers and the lenders. And
I think Patrick, with the potential expansion of this covered period from 8 to 24 weeks, what we've been worried about is they're going to continue to answer those questions, but by the time they do, we'll already be outside the covered period, and that kind of negates the ability to make certain strategic decisions. But if this does pass, I think the fact that they're going to continue to update guidance from lender questions, borrower questions, et cetera, is going to be very helpful.
Yeah, absolutely. I mean, staying up to date on this guidance has been the most crucial part of this, because they continue to change the rules in a variety of ways, and so staying connected with your accountants and your advisors and your attorneys is the most, and documentation is going to be the key. But yeah, the guidance that follows the application is going to be key, because the application, while it did provide some guidance, really left a lot of questions out there. And so a lot of what we're going to cover today is going to really hit the high points of that application and really dig into what some of it means, because it's not always clear on its face.
Right. So let's go ahead and jump through some of that information and kick it to Lee here on how to choose options on covered periods.
Sure. So covered periods have certainly been a hot topic from the start of the Act, just given the rigid definition and time period. And as we viewed it at the time, if your payroll period did not hit exactly right, then is a portion of what would otherwise be a covered and forgivable expense excluded. As guidance has come out, the application and the subsequent rules have helped kind of alleviate that concern by creating two different periods. The first period, which applies to all borrowers, is kind of what was said at the outset, which is an 8-week period that begins to run at the disbursement of the PPP loan. However, subsequently, they created the alternate period, which is 8 weeks starting on the first day of the first pay period following the disbursement of the PPP loan. It's noteworthy that the alternative is only available to those who are on biweekly or weekly payrolls. So if you utilize multiple payrolls, you should be able to utilize this protection. It is also noteworthy that the Flexibility Act, which you've heard us make reference to on several occasions today, that has not yet passed, but we expect it will, would extend both of these periods to the earlier 24 weeks or December 31st of 20. Just kind of a practical takeaway is analyze your payroll costs to see which period is better for you. A lot of people can take advantage of the alternative period, and it may make sense to do that.
All right, Kami, next slide.
So kind of following up, substantively what we were talking about first is, it's important to do analysis relative to these periods just to see, do you get an advantage by falling into one or the other? Good part is you have time to figure this out, because the deadline right now is October 31st, 20, and payments on the loan don't start till 1/1 of 20. Though the PPP Flexibility Act push those time periods back to 12/31 and 1/1 respectively.
All right, Cami, next slide.
Yeah, this is Patrick. I'll jump in here and talk a little bit about eligible payroll costs. One of the first things that we want to clarify, though, is that gross payroll and not net payroll is what is being used. So originally we thought that it was going to be your gross payroll, originally we thought it was going to be your net payroll.
Hey, Patrick, this is Chad. Why don't you tell everybody the difference real quick between gross and net payroll?
Sure, yeah. Well, I mean, your net payroll is obviously going to be the amount of your payroll after your FICA and your federal income tax withholdings. And that was kind of the feeling that everybody got was what we were going to base our payroll on. But guidance came out, and the Treasury has made it clear that you do use your gross payroll when you're calculating payroll costs.
So you can use gross, to clarify.
Correct.
All right.
So as a matter of example, if you pay somebody, $10,000 during the covered period, over a couple of months, and again, we don't know if that covered period is going to expand, but it sounds like it is. Originally, we thought when we calculated the loan, we used gross payroll, but the CARES Act specifically talked about net payroll under the forgiveness, quote unquote, covered period. So that $10,000, the employee may only take home $8,500 net of FICA and federal income tax withholding. So we thought you would only use that $8,500. The good news is you will use the $10,000 number.
That's right. Thanks for that clarification, Drew, on an example. But another big thing, too, that they've clarified in the most recent guidance is that bonuses and hazard pay can be included in your payroll costs. So a lot of employers are wanting to pay their employees retention bonuses, or they're wanting to pay them additional pay for working during this time. And the Treasury has come out and clearly said this is considered similar forms of compensation and thus would be forgivable payroll costs. One big thing to note about that, though, is that even these bonus and hazard pay is now forgivable. You still have to be mindful of the $100,000 cap per employee. That comes out to be, under the 8-week covered period, approximately $15,385 per employee. So if you pay these bonuses or you pay them hazard pay, it still can't make any individual employee exceed that cap.
Hey, Patrick, I want to talk about that cap for just a minute. We've got noted in here that the cap's at $15,385, and I know there are some interaction of self-employed individuals. That number is actually exactly correct for a self-employed, sole proprietorship or a partner in a partnership because of the flow-through effect on that. But because they take that 8 into 52 calculation times that 100 grand, that's what results in that $15,385. However, if you're paying an employee $250,000, let's just say, and you are paying that employee on a monthly basis, wouldn't that number actually be that $8,333 times 2 if you happen to have 2 monthly payrolls fall within that period? I know that seems somewhat insignificant, but you think about the PPP forgiveness and the impact. Every $1,000 is $1,000 in your pocket, and you've got a fair number of employees that can be meaningful.
No, I think you're absolutely correct. Yeah, so don't let that $15,385 be misleading. I think Drew makes a great point, and they do use that example in the guidance, but it would come out a little bit different if you're paying somebody on a monthly basis, or even bi-monthly, I guess. So that's something to be mindful of. I think really the key thing to focus on there is just you want to make sure you're not going over the annualized rate of $100,000, which is whatever that would be for that employee based on their payroll schedule.
And I'll just make this point. And thanks for that, Patrick. I think so often, and I'm sure we've got a lot of advisors, CPAs on this call, and you think about, Forbes used to send out to 100 CPAs across the nation a set of tax facts and get back from them tax returns, and they literally got back 100 different versions. I think you're going to see that a lot here too, and I think that's where there's some bunts and singles that you can get out of this, and even maybe some doubles in terms of how you interpret this and how you calculate. There's not just one method. And they haven't been, even as much guidance as they've come out with, there's still tremendous ambiguity in that guidance. And I think there will continue to be. So, being mindful of some of the edges of this thing can be beneficial, and it could move the needle, 50, 100 grand or more.
Absolutely. Great point, Drew. One other thing to be mindful of that we noticed, at least, was the interim final rule is silent to bonuses paid to an owner or a partner. And so one interpretation that's been taken by a lot of professionals out there is that they may see this as a dividend rather than a bonus. So we don't have any true clarity on that at this point, but just be mindful of that if you're paying bonuses to an owner or a partner.
Yeah, and Patrick, I know this has been something we've debated internally a bunch, is that kind of issue. But the reality is, at least our view has been, look, if you're trying to get maximum forgiveness and you're otherwise going to pay those payments to partners and or employees and or owners of the business, et cetera, I don't really see a harm in doing it, especially if we get some expanded time to figure all this out. But the fact of the matter, if you've got to have the actions kind of taken and done within that covered period, whether or not you use them in your forgiveness, application will really be up to you. What I think people need to not do is do things that are foolish and pay monies that they otherwise wouldn't pay, and then look up and go, well, I paid that money and I didn't get forgiveness, and now I owe this money back to the bank. But I don't think there's any harm in paying a bonus to an owner under that cap, or paying a spouse or something like that, if it's really just a transfer of dollars from one pocket to another. I mean, be mindful of tax impact of that, but I don't see a real big downside.
Absolutely. And I probably should add that to everything I'm saying here too, is not directly telling you not to do these things, just to be mindful of their impact, that they may or may not be forgiven. So, I mean, it's not, everyone's got to operate their business the way they want to operate their business. But most of what I'm saying here is just directly related to the forgiveness. So it was a great point, Drew. And so now we're just going to kind of walk through the basics of what eligible payroll costs are, and then we'll move on to non-payroll costs. But to start with, payroll costs are generally going to be forgivable so long as the amount of your payroll costs are equal to at least 75% of the total amount of forgiveness, and that they were either incurred or paid during the covered period, or alternative payroll covered period if you use that period. I will note here that the Flexibility Act would reduce this to 60%, but as it's written today, we're going to stick with 75 because that's what the rules say. And so also, this isn't a complete prohibition. If you end up with 70%, they're not going to tell you that nothing's forgiven. It's just going to be, your forgiveness amount's going to be reduced down until that proportion gets back to 75%. And so your payroll cost is going to be considered incurred on the day that the employee's pay is earned. And payroll costs incurred but not paid during the borrower's last pay period, during the covered period, they're still eligible for forgiveness as long as they're paid on the next pay date. And just to make note, borrowers can only count payroll costs once, either when it's incurred or when it's paid. And so, for example, if an employee is paid 2 weeks in arrears and they work for 2 weeks and then they are paid a week before the covered period ends. So it allows the employer to take the next week and consider that as part of the forgiveness, because the employee worked for 1 week, the employer wasn't going to pay them for another week, and that would have been outside of the covered period, but the employer gets to account for it as though it has been paid.
So, Patrick, one way we could do it, and I think we have some flexibility there because of the words incurred or paid, at least our interpretation has been, okay, well, you could take that position like you just laid it out, right? I pay their last 2 week payroll a week before the covered period ends, and then I take that next week's of accrued payroll that I've yet to pay, and as long as I paid on the normal pay date, it would be forgiven. But alternatively, I could take the position it's based on paid and say, well, you know what, I'm going to pay that last payroll before the end of the covered period, and I'm going to advance 1 week on the payroll. As long as I pay it during that period before that cover period ends. Would you agree that that would probably be acceptable? Subject to the other caps or limitations.
So the payroll cost wouldn't be incurred until after the cover period, but it was paid within the cover period.
Correct. Correct. A week of it was incurred, a week of it wasn't incurred, but I went ahead and advanced. I mean, a lot of employers do pay 2 weeks in arrears, or may pay 1 week in arrears, but pay every 2 weeks. I mean, you can do it so many different ways.
Right. I think if you stay within your 75%, I know on the front end, we've taken the position that payroll incurred before the date of distribution of the loan can't be included. Even if you pay it inside the covered period, you still have to start on the day of your loan distribution. But on the back end, I think there's a little bit of flexibility and interpretation on whether or not you can do the example you just used where you're advancing that week of pay. But I think as long as you stay the main thing there is going to be to stay inside your 75%, or if it was reduced to 60. But as long as you stay inside your limits there, I think you have a little bit of flexibility.
Yeah, that's right. And we've got some questions that we'll hit in Q&A related to this matter. Let's see if we can't go ahead and get to the next slide and get on to the Q&A.
Sure. So the eligible non-payroll costs, nothing's really changed here from what they come out. It was pretty much as expected here. You can only have up to 25% of your loan forgiveness made up of non-payroll costs. And based on a strict interpretation of the guidance we received, it appears that if you have a reduction in your eligible forgiveness due to a reduction in FTE employees of the salary hourly wage reduction, that this could also affect your 25% of non-eligible payroll costs.
Patrick, I want to hit that real quick. It's just as again, a good example. Sorry to slow it down, Chad, but I think this is important. If you have a $100,000 loan, you're required to spend at least $75,000 of that on payroll, at least as it stands right now. May change that $60,000, but right now what we know is 75%. So let's say theoretically you only pay $65,000 in payroll, so you're not hitting that cap of $75,000. So you take that $65,000, you divide by 0.75. That gives you a maximum forgiveness of $86,666. So you're down about $13,500 on your eligible forgiveness. But if you notice, now you take that number times 25%, the max you can have forgiven on eligible non-payroll costs is $21,666. So there's an interaction in that 75% formula with your non-payroll costs. In addition to what Patrick was mentioning, if you have an FTE reduction that causes a reduction in your forgiveness, that also has that same effect.
Good point here. As for what makes up the eligible expenses for non-payroll costs, nothing's really changed from the beginning. These obligations have to be in place prior to February 15th, but it's your interest on your mortgage obligations and business loans for real or personal property. You can't pay prepayment of principal, and you can't have prepayment of interest, and you also can't pay principal. This is just on your interest on these obligations. You can pay your rent for real or personal property, so your property or your equipment rentals, and then also utility payments, which includes electricity, gas, water, transportation, telephone, and internet. And just like we've mentioned before, the Flexibility Act would increase that percentage up to 40%, but as it stands today, it's capped at 25%.
All right, let's move on to the next
great.
slide.
Thank you. Yep.
Thanks, Patrick. As he just alluded to, a reduction in FTE employees, full-time equivalent employees, during the covered period will result in, or could result in, a reduction in the amount of loan forgiveness that the borrower is eligible for. Generally, the amount of the reduction is the same percentage as the percentage reduction in the FTE employees. So this raises the question about, number one, what is an FTE employee? And number two, what is an average FTE employee? And how do you get that? The first question, what is an FTE employee? That there is no definition in the CARES Act of a full-time equivalent employee. The SBA has interpreted that to mean a employee who works an average of 40 hours a week per week. And so there was a bit of a question about how that would be interpreted. And in the guidance, the SBA actually acknowledges that they considered using 30, they considered other numbers, but they found that 40 was more consistent with the Act. So if you have salaried employees who work 40 hours a week each week, that's what they're paid for, then you don't have a problem there in determining your number of FTEs. They're going to be a full-time employee. Where this really comes in is if you have employees who are paid for less than 40 hours per week on average during the covered period, and as we'll see in the reference period, which we'll talk about here in a second. In those situations, what you have to do is determine the number of full-time equivalent employees. Then you have to aggregate those hours, the number of employees, and you have to determine how many FTEs you had during the reference period versus how many employees, full-time equivalent employees, you had during the covered period. And if that number is less than 1, then you will have a reduction in the amount of the loan. We're going to walk through this. So I used a couple of terms there that are key. The first step in determining whether a reduction is applicable is determining the reference period. The SBA has authorized 2 reference periods. The first is February 15th, 2019 to June 30th, 2019. The second is January 1, 2020 to February 29th, 2020. For seasonal employees, there is another alternative. They can use any consecutive 12-week period between May 1, 2019 to September 15, 2019. Once you determine the reference period, the next step is to determine if there is a reduction, determine the number of FTEs, then determine if there was a reduction during the covered period. And we'll walk through an example here. Yeah.
I want to stop for a minute because I think it's important. How do we get to the current average FTE? So once you've chosen which period, and by the way, you can choose the lower of the 2 as your reference period.
Correct.
You have to give you a little leg up on the calculation. But the other thing that's very key, it depends on how you pay your employees. If you pay them weekly, you would take your FTEs on a per week basis during that reference period. You would calculate your FTEs every single period, and then you would average those based on the number of periods in that observation or reference period. So if you have 12 payrolls within that period, you're going to take your FTEs every single week, and you're going to divide those by 12 to get to your FTEs for that reference period. And we'll get into kind of how you can view those FTEs. There's a couple different ways you can do it here in just a moment. But sorry to interrupt you there, Brandon.
Yeah, no. Actually, Drew, you made a really good point there. And the regulations, I would say, are not exactly clear on how you calculate the average hours per week. But as Drew clarified, that can depend on what your payroll period is. So the first step in determining the average FTEs is calculating the average number of hours a part-time employee was paid per week during the covered period. For example, if an employee was paid 30 hours per week on average during the covered period, the employee would be considered to be an FTE of 0.75. Similarly, if an employee was paid for 10 hours a week during the covered period, the employee would be considered to be an FTE of 0.25 because that's 10 divided by 40. essentially. Alternatively, and for the sake of administrative convenience, borrowers can elect to use a full-time equivalency of 0.5 for each part-time employee. So, and that's simply out of recognition that some borrowers may not have the documentation necessary to do this. Now, this calculation is an alternative. So each borrower should run the numbers under both calculations and, again, determine which is best for your business. At this point,
Brandon, this is what I want to point out too, relative to those two different calculations. So just to recap, you can either get, an employee has 10 hours, you can count that employee as 0.25. You can't use both. You got to decide which one you're going to do, or you can use the simplified method and take everybody who has 40 hours or more, count them as 1. Anybody who has less than 40 hours, count them as 0.5. So you can do it based on a tenth of a point, or you can do it based on 0.5 or 1. Any employees that have more than 40 hours, it's not more than 1. It's capped at 1. I will tell you that borrowers who have a lot of part-time employees with few hours, 5, 10, 15 hours, etc., would probably be better using the more complicated method. If you have a lot of employees who are in the 30-hour range, 32 hours, 35 hours, high 20s hours, that can make a big difference using that simplified method, because under the more complicated method where you divide the hours into 40, 30 hours would be that 0.75. Well, you can count those all as 0.5 under the simplified method. So, and this slide actually kind of walks through that distinction. You can see the difference, depends on your hours base and your average hours base. On the left-hand side, you can see it's not a whole lot of difference. On the right-hand side is a pretty meaningful difference.
Yeah, and I think the point of this slide, one of the things to take away is that, the closer you are to 40 hours per week, and then probably the better it is to use that first calculation. If you have a lot of employees who are, working, 10 hours a week or so, for example, then the second calculation works best. One of the questions
too, I would say this too, this also affects some of the decision making. You're now one month into a 2-month covered period, or potentially 1 month into a 4 or 5 month covered period, depending on this pending legislation. If you use this simplified method and had a lot of people that were right under 40 and use a lot of 0.5s, you may want to bump those people's hours up just enough to get them to 40 so they count as 1s during the covered period.
Yeah, that's a really good point. In managing these calculations will be a big part, especially if you have a large number of employees who work part-time schedules. It's important to point out that the reduction is actually subject to certain exemptions. So, there was a lot of concern at first about what happens if I have an employee who voluntarily resigns. What happens if, they are terminated for cause? And basically, the SBA recognizes that that there is appropriate considerations that should be taken into account, and that employers shouldn't be penalized if an employee doesn't come back, if they were offered their position and they don't accept that, or if they have to be terminated for cause. So there are basically three exemptions. The first, again, is terminated for cause not related to COVID-19. The second is an employee who voluntarily resigns. And then the third is an employee who requests a reduction in hours. As it relates to a former employee, borrowers are relieved from the FTE employee reduction calculation so long as they can show that the borrower made a good faith written offer to rehire the employee. The employee rejected the offer. The offer was for the same position at the same rate of pay and the same number of hours. And then the borrower maintained records documenting the offer and rejection, and also that the borrower informed the unemployment insurance office of the rejection within 30 days. So there are some significant record keeping requirements if you are looking to take advantage of that exemption.
So
again, the next.
Just to that point, if you're right now in the cover period and you haven't made a written offer to these employees who may have already rejected coming back, you may want to go back and do that, make that written offer, and if they still decline it, go ahead and inform the unemployment office of their rejection of rehire.
Yeah, and just to that point, Drew, you need to make the offer in a way where you can document whether the employee is accepting it or affirmatively declining it. And make sure, don't just send out a letter. That letter could go to nowhere and you get no response. You're going to have to prove that they declined it. So make sure you think through that. Moving on to the next slide, we talked about this example, so I don't want to linger on it. But again, it shows the effect of calculations and how they can affect forgiveness and the reduction in the amount eligible for forgiveness. Again, the closer to 40 you are, probably the first example is better for you. The closer, if you have more part-time employees, the second calculation is probably going to be best. But you need to run the calculations under both tests.
Lee, we're going to turn it over to you.
Okay.
Sorry, I was on mute. All right, borrowers that have an FTE reduction that was just covered by Brandon but qualify for the safe harbor will be exempt from any reduction in the amount of the PPP loan forgiveness. To determine if you qualify for the safe harbor, you must satisfy following criteria. Number one, calculate your average FTEs for the pay period that includes 12/15 to 20. They commonly call that the look-back period. And as compared to the look-back period, if the borrower had a reduction in FTE during the period of February 15th of 20 through April 26th of 20, and, which is an important and, prior to June 30th, brought the FTE number back to the FTE number that they had during the look-back period. Now, this is one of the things that the PPP Flexibility Act is looking to extend to December 31st of 2020. And an FTE reduction is not the same reduction used to determine the safe harbor. So the FTE reduction uses FTEs from a pre-COVID period and compares it to the FTEs during the covered period. A reduction causes loan forgiveness reduction. The second is the safe harbor reduction looks at the FTEs as of 2/15, and only if there's an FTE reduction during the period of 2/15 to 4/26 as compared to 2/15, then the borrower can eliminate that reduction by rehiring former employees or hiring new employees prior to June 30th.
Lee, this is Drew. This section confuses the heck out of me, and I gotta believe it confuses the heck out of just about everybody on this call. Let me give you just some facts and tell me kind of what your thoughts are. Right? Let's say I use the observation period or kind of baseline, if you will, of that. I can't remember what the two periods were, but I think one of them is basically Q1 or January 1 through February 15th of 2020, right? And I've got, let's just say 20 FTEs. But from 2/15 to 4/26, I drop to 10 FTEs. Okay. So then I'm by June 30th or maybe by 12/31, if the bill passes, I'm back to 20 FTEs. But during my potential covered period, again, assuming they don't extend it, I'm just in the 8 weeks. I only have, 12 FTEs. But as of June 30, I pop back up to 20. What happens? Or do we really know or understand how this all interacts?
We don't yet fully understand how it interacts, and I'll be candid with you. It's one of those things that every time I'm looking at it for somebody, I kind of walk through the criteria to figure out if they qualify for the safe harbor. Patrick, did you have any?
Is it that the safe harbor eliminates? So let's just say I'm at FTE reduction, I remain at that 12 FTE count, so I'm down from my original 20 by 8. So I theoretically have, 40% reduction in forgiveness. is the theory that getting back up to that 20 by that safe harbor would eliminate that 40% reduction, or how would that work?
Yeah, so it would essentially get you back over the threshold so that you're not hit with the reduction.
Okay. So theoretically, I need to hire, if I'm trying to get maximum forgiveness and I'm trying to get my business back off the ground by the end of this safe harbor period, I need to jump back up to my FTE count previously.
That's correct.
And say that one more time, Drew, and maybe walk through some numbers of if you had this many at this date and now you have this many, here's what you need to do.
Patrick, you want to take that?
Yeah, look, so, and Drew, your example was really good. The one thing I would point out is, so if your look back period from January 1st to February 15th, you had 20. And on February 15th, you had 20. Then yes, it doesn't matter what your reduction is during the covered period as long as you get back to 20 by June 30th. So let's say it a different way. On January 1st to February 15th, you had 20, but on February 15th, you ended up with 15. Well, by June 30th, you only have to get back to 15. You don't have to get all the way back to 20. So you're only going back to whatever you had as of February 15th. So in other words, if you had a reduction from the original look back period that occurred on February 15th, you only have to get back to that number. Does that make sense? Did I confuse it more?
Yeah, so, or if you just ran the test straight as it is in the CARES Act or in the guidance, and you went from 20 to 15, you've got a 25% reduction. However, if that reduction occurred from 20 down to 15, from February the 15th through April 26th, you only have to get back to that 15 in order for you not to have that 25% reduction. Is that what we're saying?
That's correct.
So it really makes the FTE reduction a little easier to hit depending on when you had layoffs.
Absolutely. I guess unless you had an increase, because you're looking back at that February 15th date. So
right, but it would be average FTE, so you would run the same FTE calculation to get to average from February 15th to April 26th. Come up with an average FTE during that period.
That's right.
Okay, that makes sense. All right, let's keep rolling.
Move on. Yeah. So, and this is Patrick still. I'm going to take the wage reduction test. And so just to make a couple of points about the wage reduction test before I actually get into the calculation. And I think one of the most notable items we got is that the FTE test and the wage reduction test, and for clarity purposes, the wage reduction, I think it's salary or hourly wage, but I'm just going to call it wage test for clarity. They do work together. But one thing is the wage test is only run on employees that you actually are paying wages to during the covered period. So if you have an employee that was working for you in the first quarter, but they're not working for you during the covered period, you don't have to calculate their wages. And so I had a lot of clients I know, and I think Drew did as well, ask that question, and you're only running it on wages paid during that period.
Well,
but obviously,
that was one of the biggest things I think from the forgiveness application and guidance coming out is we had no idea how these two tests interacted, and we felt like they could be almost have a doubling effect. So between the not paying an employee during the period, there is no wage reduction because you can't calculate the wage reduction, and you're already getting hit on the FTE. But in addition to that, do I understand that if you have an FTE reduction relative to that employee, they're working less hours than they were before, you throw them out of the wage calculation too?
That's right. I was going to hit that on the next slide, but you're right, absolutely right. There's two things. One, if you don't have the employee at all, you don't count them. And if you do have the employee, but you're already getting hit, or for whatever reason they're in the FTE calculation, you don't have to. You throw them out of the wage reduction test. So you don't get hit twice. You're not going to be double penalized.
Effectively, you're getting an FTE reduction relative to that employee. You don't also count them in the wage test because it would be a compound.
That's right.
And in addition,
that's right.
You also do not count any employees over $100,000 or who have variable compensation like commission or something like that.
That's right. And so the observation period didn't change. We're still looking, the look back period for the wage reduction test is still the first quarter, January 1st, 2020 to 3/31/2020. That's what your base look back period is going to be based on. And then the employer will calculate an average wage based on the amount of compensation paid per pay period on a gross basis and divide that by the number of pay periods in quarter one. So if you pay bi-monthly, you're going to end up with 6 pay periods for the look back period.
Got it. All right, good deal. Let's go ahead and go to the next slide.
This next one will go pretty quickly.
Yeah, one note I want to make, this is a very important note, so listen up. I believe the Senate just passed the PPP Flexibility Act.
That's good news.
Well, you know, Drew, we knew that was going to happen when we scheduled this webinar a week or so ago.
We scheduled it today for that reason.
Yep. Okay, well, let's come back and hit that in Q&A. Let's wrap up some of the prepared remarks and jump into Q&A and deal with the audience.
Hold on, before we do need to get through the EIDL loans.
Right. Yeah. Yeah, and
I want to make one last comment about salary and wage reduction that I thought was really crucial in the guidance, and that's that it is you only do it per individual, and it's 25% reduction or more, but you only have to count the excess of the 25%. So if you have an employee that makes $1,000, you reduce his pay to $600, which would be a 40% reduction. You only have to apply that 15% over 25% to your forgiveness, and that I'll leave that as my last comment on it.
Yeah, so I'm just going to briefly touch on the EIDL loans before we turn to the Q&A, and we have a lot of questions that have come in already and that are coming in, so we want to leave time for that. But this is a very important topic, and it's something that has been overlooked by the SBA. You know, they really paid a lot of attention to the PPP program, getting that off the ground. But then we had this separate program that was already out there. It pre-existed the PPP, and borrowers were simultaneously applying for both loans in both programs. And basically, you know, everybody's familiar with the I want to say $10,000 advance, but it turned out to be not $10,000. The loan advance that Congress authorized under the EIDL, and that incentivized a lot of people to just apply for an EIDL whether they thought they would get it or not, because it was really essentially free money to the extent that they awarded it. The EIDL, though, now we're seeing a lot of activity in that area, and the SBA has started to fund these loans. As I mentioned, though, these loans pre-existed the PPP, the CARES Act. The CARES Act made a number of changes to the EIDL program, and these were very fundamental in several respects. So, for instance, prior to the CARES Act, you had to show that you could not obtain credit elsewhere in order to get a EIDL loan, and you also had to provide collateral for that loan, and regardless of the amount, and it was subject to underwriting based on typical lending standards, taking into account the requirements. The CARES Act did away with the requirement, for instance, that you be able to obtain credit elsewhere. So that really opened up the market to most businesses to obtain these loans. It also did away with the requirement for collateral for loans under $25,000. And it extended the term and set the interest rates for the loans. As the loan documents have come out, though, what we're noticing is that a lot of the terms that are in these documents are not necessarily consistent with the provisions of the CARES Act. And some of these terms are they're downright onerous, frankly. and could be a trap for the unwary for a lot of businesses. And so, the bottom line is you need to be very careful when in considering whether to accept an EIDL loan. A borrower has 2 months from the date that the loan is awarded to determine whether they want to accept that loan award or not. But if you do, just note that you're going to be subject to several restrictions. How can these affect you? Number one, you per the terms of the loan, if it exceeds $25,000, you will have to sign a promissory note, and you grant a security interest in all of the collateral, tangible and intangible property of the business. So this includes inventory, this includes accounts receivable, and other collateral. This could be problematic, for instance, if you've already granted a security interest. Second, there are restrictions on what you can use with that collateral or what you can do with it. During the term of the loan, you cannot make any transfer or do anything with that collateral outside the ordinary course of business without the written approval of the SBA. In addition, there are several restrictions on the use of funds. And so the loan is intended to be a working capital loan. It's intended to provide for the working capital needs of the business, but the loan documents do not necessarily define what working capital needs mean. They do insert several restrictions. So, for instance, you can't make a distribution during the term of the loan. It is very broad language that would restrict being able to make a distribution. Think about this if you're an S corp or if you're a partnership, and then that could be a problem. Finally, I think one of the most important restrictions, the loan documents prevent you from taking an advance on an existing line of credit or anything that would take priority over the SBA's loan position. And this again is a relic, really, in my view, of the previous terms of the EIDL prior to the CARES Act, and they didn't adjust that, take into account the changes made by the CARES Act. Where can this pop up?
So, Brandon, now that you scared the crap out of everybody on the EIDL loans, maybe a little bit of practical advice. I had this question come from a friend earlier about things. Basically, we're going to tell everybody not to take them. And, I think there will be some guidance that comes out on this. It's just that the PPP required so much focus that the EIDL program has gotten almost no attention. And I think that there will be some attention pivoted to the EIDL program. Can't guarantee that. But I'll tell you, Lisa, our position has been, look, let's maybe take the loan. Let's sit on the proceeds. Let's wait and see if some guidance comes out. Technically, you're not supposed to make a distribution. Technically, you're not supposed to draw from a line of credit. Could be an event default. All these scary things. However, if you're sitting on the cash and the interest rate's pretty darn cheap, you're not talking about a ton of money. You're talking about 150 grand. And you're sitting on that cash. Look, if they come back in the alleged default, pay it back. But on the other hand,
exactly,
guidance that really loosens a lot of these restrictions. I think we're going to feel foolish saying, well, we just decided not to take it in the first place. I mean, so I think you can do things to guard yourself against a real problem with the SBA. And I'll tell you the other thing is they're going to be overwhelmed with PPP compliance and audits and all those things. I just don't see them really spending a ton of time on this.
Yeah, and it is interesting in one respect because the restrictions and the conditions that are applicable to these loans, they're not set forth in regulations or any regulatory guidance. They're actually set forth in the loan documents themselves. And so, unless really Congress came back and enacted a statute that somehow changed how these loan documents would be interpreted or applied, then it's just like a loan between you and any other bank. I think the consideration, to Drew's point, is just make a careful consideration before you take it. don't turn down the loan if you get it. Keep it accessible for the 2 months. If you need it, then it's there. And then look out. A lot of changes, things are happening as we speak. And if it turns out that you need it, take the money. I'll tell you this: I've taken an EIDL for my own firm. In my case, it made sense. If you don't have an existing line of credit, if you don't have other things that could interfere, it may make sense for your business. Everybody just has to make an informed decision and carefully think about that.
Right. Thank you, Brandon and Patrick and Lee and Drew. With that being said, we're a couple minutes behind. I'd like to go ahead and jump straight into Q&A, and Cammie, I'll come back and hit some of this if need be, but our information is on here. If anybody needs anything or we don't address your question, or if there's anything that we can do to help you, please contact one of us and we will be more than happy to help you and dive right into anything you have. So feel free to call or email us at your convenience. With that being said, I'm going to turn it over to Cammie and ask Cammie to lead us through Q&A for the remainder of the session. Cammie?
Okay, thank you, Chad. First question we received in advance. If you applied for the EIDL advance and received funds but no longer need to pursue a greater loan, must you file a full EIDL application to avoid recession of the grant funds? I apologize with a typo. If so, can you just apply in the amount already received?
Yeah, so I think I understand that question to mean, number one, can you receive the grant and not receive the loan? Yes, you can. Can you receive the loan and not receive the grant? Yes, you can. If you received the grant and you get the loan, but you don't want to take the loan, do you have to give the grant back? No, you don't. The grant is awarded regardless of whether you take the loan or not. It is not subject to any strings. There are no strings attached for that money.
Although Brandon, and I think the passage of the Flexibility Act may change this, but one thing that was a little bit of a surprise is on that PPP forgiveness application, they kind of backed that grant out because they counted against you on the forgiveness.
Yeah, and
Patrick, that's correct. Your amount of forgiveness is going to be reduced by the amount of an EIDL grant you received.
So in other words, it wasn't really a grant. It was kind of a grant that they took back away from us.
It was a grant that they took away if you took out a PPP, basically.
Yeah, and I will say that's consistent with statutory language there. But can you give back the grant? No, there's no mechanism for giving that money back. If you took it, you're simply going to face that reduction.
Okay. I'll keep going with the next question. I'm self-employed with no other employees and I have a home office. I make intermittent distributions to pay myself as needed, including my rent, a portion of which is used to house my office. I have concerns about the ROI on amount of time and paperwork needed to apply relative to the likelihood of being accepted and or forgiveness. Is it worth going through this and applying for someone in my situation?
I'll take that one. This is Drew. I don't know, somebody else have to speak to this. I don't know if you can still apply. I know a lot of banks are not allowing additional applications, but I believe there are still some out there. So presuming you can apply, and I have no idea your economic circumstances, but if you're a sole proprietor or partnership or something like that, earning in excess of $100 grand, kind of the way that at least we look at it is it's the effect of a free, call it $15,385, which is the calculation Patrick and I were talking about earlier. So, if 15 grand is not really worth it to you, then fine. But on the other hand, you're a sole proprietor, you basically have to present your 2019 tax return And there's not a whole lot of other evidence that you really have to provide. Furthermore, the forgiveness is pretty much automatic for a sole proprietor in that situation. So it may very well be worth it.
Okay. Question. I operate a dental practice and have secured significant EIDL funds across 4 entities, 2 operating companies and 2 real estate LLCs. Assuming I don't need the capital to operate the businesses, is there a way I can use it to develop a 3rd office?
Brian, you want to take that one?
Yeah, so the EIDL loan documents actually expressly prohibit you from using the proceeds from making additions or capital improvements. So that is one restriction.
However, money is fungible, right? So theoretically,
that's right.
On 150 grand of working capital in your business that you use to make sure you have enough money to pay your bills every month, you got a $150,000 EIDL loan. Well, theoretically, you could take that $150,000 as working capital and go ahead and deploy it into starting your next practice, and instead use the $150,000 EIDL to replenish that working capital.
That's right, and there's actually no restriction on doing that. I guess one of the things I just want to point out quickly is that yes, there are some significant restrictions in the document, but one big out is that there's nothing preventing you from the time that before you accept that loan from actually taking your existing funds and using your existing funds to do these other things. You're just replacing that capital with the EIDL loan. And so, if it makes sense to do an improvement, we'll take your existing funds, put that over in a side account so that you can show that you did not use EIDL funds, and then go out and make those improvements using that capital.
Okay. Question. What about a normal salary, not a bonus, paid to an owner? Has it been determined how this will be treated with regards to the 100K cap?
Treated like any other employee. There's no distinction between an owner.
And what he means by that is you're still subject to the 100,000 cap.
Yeah, of
Sure,
course.
you want to elaborate?
You're not.
Yeah.
You're not limited in any way differently than any normal employee, except I do want to make this point. You do not count benefit costs for the owners. So if you're an owner and you're under the company's health plan or 401k plan or anything like that, you do not count those costs as eligible payroll costs.
Right. Thank you. Cammie?
Question. I would like to consider the EIDL loan, but I'm quite concerned with SBA scrutiny. Specifically, I have an advisory LLC that receives management fees for managing another separate LLC, of which I'm also the owner. Should I be hesitant?
Really, you should make an informed decision. I think that it really depends on the needs of your business. Again, take into account all of the factors surrounding that. So existing credit facilities in place, whether you have plans for that and you need the capital, but it's a good, cheap source of capital. So I would carefully think about it before turning it down. And then I would not turn it down until the very last minute. Again, money is fungible, so there's some planning that can go on in order to utilize this if necessary. But I don't think I could say a blanket no to anybody.
Okay. Under non-payroll utility expenses, what constitutes transportation expense? We operate some delivery vehicles. Can we use PPP dollars for fuel or other vehicle expenses?
Patrick, you want to take that one?
So I think it would no. I think the answer would be no. I think you have to have some type of utility service agreement that you're paying a monthly bill on. So on your transportation, and I'm not sure that they've gone into much clarity about what exactly they mean on transportation, but I would assume it would probably be along the lines of insurance for a company-owned vehicle. But I don't know that fuel would be something that would be able to be considered a non-payroll utility.
Yeah, I think there's been absolutely no guidance on what transportation means. So
there hasn't. So
I think, again, going back to being flexible, you're going to do that stuff anyway. I would accumulate those costs and keep track of them, and we may get some guidance that clarifies what it means. So I wouldn't automatically assume it's not covered, but we're going to have some time. I mean, I think, Patrick, you guys pointed out one of your memos that you sent out on this topic that, we're going to have some time to make the application for forgiveness. It's really up until the first payment date. So keep track of all that stuff. We may get guidance that says that's absolutely acceptable, but today we have none. So anything we would tell you would be logical speculation.
Okay. Have we received clarification about whether the expenses paid with PPP funds can be deducted as business expenses on 2020 taxes? Do we get it both ways?
Brandon, I'd like for you to address this because I know we've talked about this ad nauseum.
Yeah. So the originally we believe that you did. The IRS has come out with a revenue ruling that indicates that they've taken a theory that no, you cannot deduct business expenses with those that are paid from the proceeds of the PPP. I disagree with that. I think that the reasoning is not sound, and I ultimately believe that could be challenged. Now, that would mean challenging a revenue ruling that's put out by the IRS, taking an inconsistent position on a return. But there are a lot of people who disagree with that as well.
There's the act. Tax practitioners. Do we know anything in the PPP Flexibility Act? I don't know. We haven't gotten the full act yet and read it, but there may be something in there because I know that there were several. I think it was the Senate Finance Committee, the House Ways and Means Committee said they thought that was complete nonsense.
Exactly. The heads of the tax writing committees have come out and said that they disagree with the Treasury's position on this, and so that's pretty strong evidence there, and hold some weight. I do not know at this point whether there was any action. I don't believe that in the payroll in the Flexibility Act that it included anything other than direct issues directly related to the PPP loan. So this was a part of a separate section of the CARES Act. We still expect further legislation though to come out, and this could be addressed. But at this point, bottom line is that you have a IRS position that says that those expenses are not deductible. But there's a solid argument that they should be.
Okay. Let's see. If I took a loan from another company, am I no longer eligible for an EIDL loan?
So no, the credit elsewhere requirement does not apply for EIDL loans issued under the CARES Act. And so if you have an existing credit facility, if you took out a loan from another lender, then that should not make you ineligible for an EIDL loan.
Okay. Related to EIDL loan books and records, any suggestion on how we should track this loan if we decide to take it to suffice the SBA?
So what I recommend is that you actually segregate those funds into a separate account. And you know, the one difference between the EIDL and the PPP is if you have both. The EIDL is intended to be a working capital that can include salary. For if you didn't get a PPP loan, then you can use the EIDL for wages and salary and payroll. But it makes it because of the working capital loan, you don't have the record, you don't have the employment taxes and other things that you know, may necessarily make it harder to segregate funds into a separate account just for record keeping purposes. I think here that's probably the best practice. Segregate that money, show that nothing was spent on anything that's questionable or that you know, could be deemed improper under the terms of the loan. And then make sure that there is a requirement in the loan document to maintain itemized receipts for every expenditure that's made with the proceeds of the loan for a total of 5 years. During the loan period, the SBA can come in and can audit your books and records. And they can require you to produce reports and submit to an audit of those loan proceeds. So just to make everything simple, I do think it'd be advisable to segregate it.
Okay. Who will be auditing the forgiveness percentages? Our banker?
They will likely be the first. The PPP application is going to be submitted to the bank, and the bank will ultimately submit it to the SBA. And Brandon, I don't know, or Patrick or Lee, if you've got any thoughts on this, but I don't think the bank has any real culpability or liability in that. They just can't really be asleep at the wheel. So they will definitely want some documentation to support that application. As a matter of note and practice, you know, we have built effectively an internal software that we continue to update as we, you know, learn new stuff. And with the passage of this Flexibility Act, we'll have to update it again. But it's meant to effectively be able to enter all the payroll information, enter all the non-payroll expense, calculate all the FTEs under all the various periods, run all that analysis. And we intend to be able to generate a report from that we'll be able to submit with it along with some other supporting documentation. But I think the bank is going to be that first line of defense, and then ultimately the SBA will be looking at that. And/or I think they granted something like $2 billion to basically support the hiring of an audit task force. So I think there are a lot of loans, especially over $2 million, that can expect an audit at some point.
Okay. Question. If you take the entire grant and it is more than $25,000, can you return the excess and have the quarantine or lien removed?
Yes, so you can pay back the EIDL loan at any time. And again, that's one mechanism. If you just don't want to put up the restrictions, just pay it back. But the loan documents do say that if it's below 25,000, then it's not subject. That there is no collateral requirement. They do not actually go into the mechanism for releasing a security interest that was originally taken because the loan exceeded 25,000. It should be released. You know, just under, I think that the language of the loan documents contemplate that, but it's not as clear as I would hope. One thing I want to note though is
today, though, we have not seen them actually file a UCC, and that may just be creative.
Yeah, that's what I was going to say exactly. we've not seen any UCC filed yet. So we don't know if they're actually going to file that UCC and enforce that security interest. It may be that they don't.
Okay. Will the EIDL loan that I accepted create problems for a round of investor funding in the form of a convertible note offering that I'm planning to launch for my venture?
So if that note offering, if the would take is securitized in some way by collateral that is affected by the security interest granted to the SBA, then it could. In a lot of convertible debt offerings, you're looking at like a mezz debt, where you're offering the security is the interest in a subsidiary entity. In that case, then you're not granting the SBA a security interest in the ownership of the entity that is borrowing the EIDL. Only the collateral, only the assets owned by that entity. That's something that's a little bit different than some commercial loans. So it should not, if the only security is the interests of a subsidiary entity, for instance. One thing to note, though, is don't go out and transfer the assets if you have any EIDL. You can't go out and transfer the assets that you have in your parent company to a subsidiary in order to create a permissible security interest in the membership interest or stock of that subsidiary. That would be a default under the loan. So you need to plan that. That again is a situation you need to plan in advance if you're going to do that. It could be done though if you do it properly.
Okay. What if there were no layoffs during the period, but we hired some part-time employees? Can the wages of the new part-time employees be calculated into the mix and applied towards the forgiveness?
Patrick or Lee?
Yeah, and I'm just trying to think through that. Read the question one more time, Cammie.
I think, Patrick, what they're asking is, let's just say you were flatlined with employees, but you may have some reduction in the wage test formula for those employees, but you added, say, 5 new employees. What about their wages? Do they credit against any reduction in the wage test reduction?
I don't think so for the wage test, because you're counting it based on an individual employee. So somebody else's wages can't count towards.
No, but let's say that you added your 20 employees, right? You end up with $10,000 in wage reduction based on the formulaic calculations, right? But you added 3 new employees, and if you were to add their credit into there, it'd be 3,000. So now your net reduction is only 7,000. I haven't seen any guidance that allows you to do that.
I've not either. I actually think that it's somewhere in the guidance it says it can increase. It can reduce, but can't increase.
Right. Well, but theoretically you still wouldn't be increasing. But I will tell you, we are looking at that, and we are calculating those new employees and at least coming up with what that credit amount is. But we don't know how to apply it yet.
Right.
When the time comes and they haven't opined on it, I would certainly take that position.
I agree with you, Drew.
Would paid time off count towards the 40 hours FTE if paid during the period?
Well, paid time off definitely counts as an eligible payroll cost. So I don't see why it wouldn't count for FTE hours. Patrick or Lee or Brandon?
So yeah, I had a client actually ask me a similar question to this the other day, and it kind of brought up the question: Are hours paid but not worked included in the FTE calculations? I think there's arguments for and against it. I guess it depends on if it would. Obviously, an employee can't increase over 1.0 on a calculation. So if those paid time's off, go ahead.
Yeah, and Patrick, I read the guidance as saying that you look to the average number of hours that an employee was paid for. And so, I mean, this may not be correct. But I would read it as possibly allowing it, or as allowing that, without some limitation. But, you know, I would be curious to know what employers are doing, and you certainly see that.
Right. Yeah. I'm with Brandon. I mean, I think it's something that we would think would be allowed, but we just haven't had anything clearly say it yet.
Question, is it common to be awarded the EIDL but not the grant?
So yes, it is. That is happening. There is no rhyme or reason to it. Applications, I can tell you that I submitted several applications in a row for clients and others, and some have been granted, some have had no action taken whatsoever. There's no discernible pattern that I see based on the size of the business, the nature of the business, or the cost of goods sold that was reported. I really can't see any pattern there. There's got to be something, but we don't know. Some of these businesses are getting grants. Some of them have not received grants, but are getting the EIDL loan.
One explanation.
And the opposite is true as well.
One explanation, though, for not getting the grant may be a business that has no employees. In that case, you're not going to get a grant, no matter what you applied for. I say that actually, we have had businesses who had 0 employees who got $1,000 randomly. So.
Okay. If I have received an EIDL loan, should I go ahead and obtain a separate AR line of credit so that the EIDL is in a second position from a UCC filing?
Well, and that may not work. In most commercial lines of credit, they include what's called a future advance clause. And that means that even if they do not make the advance until after you've received the proceeds of another loan, that because they have that clause in the security agreement and in the UCC1, then those advances will take priority over the later loan. So in this case, it would mean that the advance on the line of credit that you may take a year from now would still have priority over the EIDL loan if you accepted it today. And that, again, would be a default under the loan document. Now, solution to that, go talk to your banker and, coordinate with them. If you have a strong enough relationship, you may be able to carve out advances, carve out the EIDL loan as an exception.
Okay. If you paid the EIDL loan back within a specified earlier time frame, is any calculated amount of interest due at the time of payoff? I understand there isn't a prepayment penalty, but would any amount of interest be due?
I believe the interest starts accruing the day that you receive the proceeds. So if you pay it back in 3 months or 6 months, there's no waiver of interest. So I believe there would be interest due.
Yeah, there is going to be interest due if you accept the loan.
Okay. I've seen mixed messages on whether or not HSA payments are going to be eligible for forgiveness. Have you heard anything?
I don't believe they would be for a couple of reasons. One, the HSA usually is not funded by the business. Alternatively, we've seen HRAs, health reimbursement accounts, are typically funded by the business, and I think that would be part of benefits for employees, but owners aren't eligible for those. Owners typically use HSAs, And because they've carved out benefits for owners and said benefits for owners are not part of the forgiveness package, I don't think an HSA contribution would be eligible.
Okay. Let's see. What about 2019 profit sharing contributions? Are those considered benefits?
Yes.
This got asked in about 4 different ways.
Yeah, yes, but not for owners. When we first started looking at all this, we got real excited thinking our clients who have profit sharing plans and defined benefit plans and all those things, wow, we're gonna really do well on this. And then they came out and Treasury again just changed the rules or interpreted the rules in their favor, or SBA did, and said benefits for owners don't apply. So we've had this with a couple of clients where we said, look, let's look at 2019. We have not filed a tax return yet. We have not made our 2019 profit sharing contributions. Let's go ahead and make those. And let's go ahead and make some of the 2020 profit sharing contributions for employees only. That would work, but for owners, it does not work.
Okay. If an expense was paid prior to the beginning of the covered period, for example, rent for the month, can the employer be reimbursed with loan funds during the covered period that will qualify for forgiveness?
This is Patrick.
Yes, that. Or Patrick, take that.
Yeah, I mean, either way, I think it just goes back to the discussion on funds, money being fungible here. I mean, no, you cannot include that rent payment that was made before the covered period started, but obviously you're going to be able to include your rent during the covered period, and that money would be reimbursable. But no, that rent that was incurred prior to the covered period wouldn't be forgivable.
Okay. Let's see. Is the grant portion over and above the EIDL now set at $1,000 per employee reflected on the loan application up to a cap of $10,000?
No, it's actually not. What you will see when you receive the loan documents and the approval, it'll just state that you're approved for a specific amount, let's say $75,000. The only thing deducted per the terms of the loan document is a $100 filing fee for UCC filings. But the $1,000 or $10,000, whatever amount you receive, is not deducted. It's treated as if you received that as a grant, separate grant.
So the one thing I do want to point out, we talked about this earlier, but just to remind folks, you got that $10,000 grant. It wasn't free. It's going to come out of your PPP forgiveness. So if you got both PPP and EIDL, that grant will cost you the $10,000.
Okay. Question. We are a construction company. We applied for the EIDL loan, received an email Saturday night that we have been denied, stating we do not have economic injury. We have had a huge economic injury with 2 major commercial projects on the books to sustain us through 2020 were both canceled directly due to COVID-19. Any suggestions as to how I may go about disputing this decision?
Yeah, there is an SBA process that you can work through. This is still a government loan program, and the decision is not final. You should contact the SBA administrator and ask to have the decision reviewed. But it is reviewable, and it can be appealed. Now, it's sort of a cumbersome process, and from my understanding, that there's a lot of backup, and the SBA is not getting back to borrowers who are requesting appeals. In some cases, it can be a month or so before they're going to get a return phone call from what I'm hearing from other practitioners who are doing work in this area. So, but yes, you can appeal it. I just can't tell you exactly how successful you're going to be and how soon that appeal would be resolved.
Okay. If we choose the alternative payroll period for payroll expenses, for non-payroll expenses, parentheses RUI, do we A, have to use that same alternative period, B, have to use the standard 8-week period starting the day of PPP funding, or C, get to choose between the two periods?
Hey, this is Patrick.
So if we choose alternative, you got it.
So my interpretation is that you have to use the covered period for non-payroll expenses, but there's nothing that expressly says that. The only thing I base my interpretation on is that in the application it says places where it says covered period only, you have to use covered period. And the only place that they allow for alternative covered period are things dealing with payroll costs, or alternative, or FTEs or salary or wages. So that's my interpretation. I don't know that it's correct. We may get some guidance that gives us some more clarity on that. And if Brandon or Drew have any thoughts on it as well, please.
Yeah, this is Chad Webb. Kimmy, I know we may have a few more questions left, but out of respect to the audience, if we could limit it to just a couple more, I would appreciate that. And then any question that we have left, we can reach back out separately to the person that sent the question.
Okay. Let's see. How soon do you believe IFR will opine on including owners receiving money as pay from their companies? Our owners receive a guaranteed payment, and they don't treat them as dividends on their personal taxes.
I think they've already clarified that earlier, didn't they, Brandon? That partners and partnerships basically were added to the partnership PPP loan, and they were going to get a pretty much automatic forgiveness equal to that $15,385. It's that 8 divided by 52 times 100 grand cap. Is that not accurate?
Yeah, correct. That's my understanding. Patrick.
Oh, mine as well.
You know, one follow-up question to that, and one that I received, again, this is Chad, is that what if you have an entity that is for the sole purpose of investing in other entities, right? So you are a partner in some other entities, but that is your sole profession. You don't have any other job or occupation. So you receive K-1s from those. They were told by their bank that they cannot get a PPP loan or EIDL loan in that standalone entity because they would have been a partner in the other entity that should have received that. Any thoughts there?
Well, I can say this about the EIDL loan. There is no requirement in there that nothing about.
I think this is Brandon. This is
an economic injury.
No. This is PPP question. And Chad, to answer your question, I mean, if you're investing in a bunch of companies, let's say you're investing in 10 companies, but you're doing it through an entity and your business or profession is investing in other entities and you're actively engaged and involved with that company that owns all those relative partnerships, I think you're a partner in your business that owns those partnerships. And yes, your business is a partner in those other partnerships, but you're not providing services as a partner and actively involved. You're actively involved in your company. I think you actually are eligible.
I agree. Thank you, Drew. Cammie, any other questions that are right before you?
So our last question can be this one. After our 8-week period is up, how quickly do we have to get our paperwork in to request forgiveness?
Based on the PPP Flexibility Act, the date to apply for forgiveness is now extended to December 31st. I will say in the Flexibility Act as well, this wasn't something that was there before, but I think if a borrower has not applied for forgiveness within 10 months following the end of their period, so whenever that period would be over for them, which would be December 31st or 24 weeks, then I think that's when they have to begin repayment. So yeah, I mean, no, you have to December 24 weeks or December 31st, whichever comes first. But you don't have to apply when your covered period's over. You don't have to apply with any certain time.
Got it. Okay, Cammie, if there are no other questions, I'd like to say thank you all again for attending. Thank you to our panelists so much for being here and being prepared. Our team at Atticus and at Balch and Bingham stand ready to serve any and all of you. And if there are any questions that you have, please don't hesitate to follow up to any of us, or follow up with any of us or with Cammie, and we will make sure that your questions get addressed very timely. So thank you all again, and please stay tuned as things come up. We will host other webinars to make sure that everyone is up to date as much as we are. We appreciate your attendance and certainly your commitment to letting us serve you. Thank you.